Let's finish up the Chapter 5 problems. I left the screen on this PowerPoint slide on purpose. So remember in your PowerPoint slides 11 and 12 deal with the different additions and subtractions when it comes to making adjustments to taxable income to determine your E&P calculation. Just want to remind you of those because the next problems that will work will deal with that. So it's actually one more exercise I want to work. It's exercise 23, bottom of page 5-29. Get to my notes here. If a corporation with common stock outstanding declares a non-taxable dividend payable in rights to subscribe to common stock on June 30th of the current year, each right entitles the stockholder to purchase one share of stock for $25. One right is issued for every share of stock owned. Thomas owns 100 shares of stock purchased 10 years ago for $1,000. At the time of the distribution of the rights, the market value of the common stock is $40 per share, and the market value of the rights is $5 per right. Thomas receives 100 rights. On September 30, he exercises 75 of the rights and sells 25 for $6. So letter A, assuming that Thomas does not allocate his original stock basis to the rights, what is his basis in the new stock? And so the key here is, so just kind of some of the general rules to think through. If the rights are taxable, the recipient has income equal to the fair market value of the rights. The fair market value then becomes the shareholder's basis in the rights if the rights are exercised. The holding period for the new stock begins on the date that the rights are exercised. If the stock rights are not taxable and the value of the rights is less than 50% of the value of the stock, the basis of the rights is now 0. Okay, so that's just one general rule to think through with that. Now, as we think through the specific situation here for Thomas, let's go ahead and compute the answer to A. So Thomas does not need to allocate the cost of the original stock to the rights because the value of the rights is less than 15% of the value of the stock. And let me just get down to a blank area here and we'll do that. So his rights are worth 500, value is 4,000. Okay, so if we take 500 divide by 4,000, we get 12.5%, and remember the cutoff was 15%. Okay, so for letter A, assuming Thomas does not allocate his original stock basis to the rights, what is his basis in the new stock? So essentially $25 exercise price times 75 shares, and letter A is 1,875. Letter B, when does the holding period begin? It begins on the date the new stock was purchased. Okay, so the date the new stock was purchased for B. For letter C, the question is, what are the tax consequences of the sale of the rights? It produces a long-term capital gain. They were worth $6. He has 25 of them that he sold. That's $150. So that's a long-term capital gain of $150. Okay, so that was just question 23, the last exercise I wanted to go through. And then I want to go through a few of the problems with you. And let's take a look here at problem 24 is the first one. And it says at the beginning of the current year, Blue Corp, a calendar year taxpayer, accumulated E&P of 100. Blue's current E&P is 60. At the end of the year, it distributes 200,000, 100,000 each to its equal shareholders, Pam and John. Pam's basis is 11. John's basis is 26. How is this treated or for tax purposes? So basically then, let me just kind of get to a blank area here. So John and Pam each have dividend income of 80. Okay, so it's 100,000 accumulated E&P. Let me just type that up here. So this is the cum E&P. That's 100,000 plus 60 current E&P. Okay, so there's the 100 plus the 60. The dividend income will be subject to the rate on the individuals. Okay, so basically that's the 160. Let me get to this part here. So 160. They each are receiving, remember, 200,000. right? So you can just see that's 160, and they're each receiving 200,000. Okay, so 40,000 each would reduce the basis at 20,000 each. Okay, so the dividend's 200,000. That's the dividend, and this is the total E&P. So clearly the difference is 40. So there's 40,000 left over to reduce basis. Okay. Now we have to look at the basis of each individual, right? So for Pam is the first one, her basis was 11. So has a basis of 11, and then half this 20,000 will reduce that. So her basis will go to 0. She'll have a $9,000 capital gain. Okay, and this is for Pam. Okay, so for Pam, she'll have an $80,000 dividend. Half of this number here. She'll have an $11,000 basis reduction, and then a $9,000 capital gain. The sum of those is the 100,000, which she receives. So this is dividend. So the dividend is taxable, the capital gain is taxable, the basis reduction is not. So that's for Pam. Let's look at John. And then for John, remember that his basis was higher. It was 26. So he's going to receive, again, 80,000 worth of dividends. Okay, so the dividends of 80,000, basis reduction of 20. And that's it. Then John's done. Okay, because his basis was higher. So he pays tax on 80,000, 20,000 basis reduction. Clearly the sum of those two equals 100,000. So that was question 24. And then question 27, I already typed in all the numbers. I just wanted you guys to kind of see through how we do it. Sparrow Corp, calendar year taxpayer, the following transactions for 18 its second year. Sparrow uses the LIFO, and this basically then it lists all these items here. Now it lists them in the problem as positives, and I've already typed in the answer here and gave them their basically the direction they should be going as additions or deductions. Sparrow uses a LIFO method of inventory. Its LIFO recapture increased by 10,000. In addition, they sold property on an installment basis. It was sold for 40,000, had an adjusted basis at 32. In 18, they received a $15,000 payment on that, and then no other first-year additional depreciation was claimed. Compute their E&P. So this is their E&P calculation. So I just want you to see this. Anything that's just kind of a number by itself is just the number. But then for this one here, the premiums on life insurance, you have to net a couple of different numbers on this one. So you have to take the 3,500 premiums paid and subtract the increase on the surrender value. So that's 3,500 minus 700. And then the increase in cash surrender value, that is the 130, and the 130 is the proceeds minus the cash surrender value of the life insurance policy distribution. So basically a policy paid out, and we subtract out of that the cash surrender value. So we get to a net number of 110. And then for the MACRS, essentially the MACRS turns into this, the 26,000 MACRS deduction. But from that MACRS deduction, we take off 16,000 of ADS, or basically straight line depreciation, that comes out of that number. And that's a straight line number that was given to us in the problem. For section 179, we're allowed to take 20% of 25,000, the allowable portion of depreciation. That's what the problem says. It says 25,000, and we can take 20% of that number. The dividend received deduction, we're at the 50% threshold. 35,000 was the dividend times the 50% because it's 20%, less than 20% owned. They tell us that in the problem, so it's 17.5. We add back the LIFO recapture, which is mentioned in the paragraph beneath the table of numbers. And then the installment gain is this. A little bit more going on with that. The paragraph beneath the list of data explains that there was 40,000 of property sold, adjusted basis of 32,000. So we take the 40 minus the 32 divided by the 40 to get a percent, and we multiply that by the cash received during the sale. 15,000 was received at the time of the sale, so we can call 3,000 of that installment gain to get down to the number. Okay, so I just want you guys to see that and see how we did that. And this is problem 28 right here. It's basically just a list of a bunch of transactions A through I, and then with each transaction we put in the appropriate amount of taxable income increase or decrease, or then E&P increase or decrease. Letter A is a realized gain, 80,000 on involuntary conversion of building. A 10,000 gain is recognized. It goes into taxable income, but no E&P effect. The letter B is mining exploration costs incurred on May 1 of the current year, 24,000 deductible from current year income. So we have the 24,000 minus. And then the E&P increase, though, there's a rule here that can only be done over 120 months. And so we take 24,000 divided by 120, get 200 a month, and then times 2 months for 16. So the difference between 1,600 and 24,000 is 22.4. Letter C is sale of equipment to unrelated third party for 240, basis of 120, and you can see no effect here. But then the difference between 240 and 120 is obviously 120 for here. Letter D, dividends received 20,000 at the 50% level of the DRD. They only own 5%, so we get the 50% level of dividends received deduction. So it's 10 and 10. And then letter E is the additional first year bonus depreciation, 45,000 claimed in current year. So we can subtract here, but we have to add it back here. Then letter F is section 179 expense deduction of 25,000 in the current year. I've got the 25,000 here, but then over here I can only put in 20% is allowed for E&P, and so 80%, oops, that should be 80%, and an $80 sign is added back. So this becomes 20,000, which is 80% of 25,000 is 20,000. So that's 80%. Letter G, impact of current year section 179 expenses deducted in succeeding year, and there's no effect for taxable income, but then we bring that back at 20%. So basically going back to letter F, the 20% we get back the next year. Okay, so 20% of 25,000. And then letter H is Macro's depreciation of 80. ADS, which is the straight line, was 90. So we take the 80 here, we take the difference between 80 and 90 here at 10. Then letter I is the federal income tax of 80,000 paid in current year. No effect here, but that's a deduction to E&P over here. So I know that did that kind of fast, but I just wanted you to see some examples of how that works, tying back to the 2 slides that are over here. Okay. As always, if you have questions, just let me know. I'm more than happy to help out.